Hey everyone, welcome back to Corporate Decoder. Today, HCW Biologics, HCWB, just filed an 8K revealing a private placement, and I am seeing a bit of a red flag on how they are funding their drug programs. Quick note, this is not financial advice, just my take on public filings for educational purposes. HCW Biologics is raising some much needed cash through a sale of stock and warrants, but the terms might not be as sweet as they first appear. HCW Biologics Incorporated is a company in the biotechnology sector, and they are working on developing new drugs. They recently announced a private placement offering, which is basically a way for private companies or smaller public companies to raise money by selling securities directly to a select group of investors, often called accredited investors. This is usually done because it is faster and less complicated than trying to sell to the general public. This filing today on the 29th of July 2026 is an 8K report. Companies file these to announce major events that shareholders should know about. In this case, the big event is an entry into a material definitive agreement, meaning they signed a significant new contract. So what exactly did they agree to? HCW Biologics is selling units. Each unit contains a share of their common stock, or in some cases, something called a pre-funded warrant, and also a common warrant. They are selling these units for $2.585 each. Now, a pre-funded warrant is a bit like a stock you buy now, but pay for later. You get the stock right away, but you pay a super small amount for it, and then you have to pay the rest of the exercise price at some point in the future. The idea here is to let investors buy stock now without triggering certain reporting requirements. The company entered into this securities purchase agreement with certain accredited investors. They are issuing and selling a total of 618,682 units. Out of these, 218,682 units will be actual shares of common stock, and 400,000 units will be these pre-funded warrants. They are expecting to bring in about $1.6 million before they pay any fees or expenses. And what are they going to do with this money? They say it is for working capital and general corporate stuff, which is pretty standard. But importantly, they mentioned it will help them continue their clinical development activities. This is key because for a biotech company, moving their drug candidates through the development process is their main way of creating value. Let's talk about these pre-funded warrants. They have an exercise price of just $0.0001, which is practically nothing. They can be used right away. The catch is that the holder cannot own more than 9.99% of the company's stock after exercising. This is a common way to structure these deals to avoid triggering certain ownership disclosures. Now, for the other part of the unit, the common warrants. These are warrants that give investors the right to buy more shares of common stock in the future. They are being issued for up to 618,682 shares. The exercise price for these common warrants is $2.585 per share, which is the same price as the units were sold for. These warrants will expire 5.5 years after they are issued. There is also a beneficial ownership limit of 4.99% on these. Here is a critical point, and it's a bit of a red flag for me. The issuance of these common warrants is actually subject to getting approval from HCW Biologics stockholders. This is because NASDAQ rules require shareholder approval. If a company issues stock or warrants that could result in a more than 20% dilution of outstanding shares, or if the issuance price is below the market price, this means investors might not actually get these stock purchase rights if the shareholders vote no. It's also interesting that some key insiders, including the CEO and chairman of the board, participated in this private placement. This can sometimes be a positive sign showing their confidence in the company, but it is on the same terms as other investors, meaning they are also subject to the same potential issues. On top of the purchase agreement, they also signed a registration rights agreement. This means the company has agreed to help these investors sell their shares later. They have to file a registration statement with the CSE within 15 trading days after the deal closes and get it approved within 60 days. This is pretty standard for private placements, as it allows the investors to eventually sell their shares on the open market without violating securities laws. This section explains why they did not have to register these securities with the SEC. They are relying on an exemption that allows companies to sell securities to a limited number of sophisticated investors without a public registration. This is because they believe these investors are accredited investors, meaning they meet certain income or net worth requirements. HCW Biologics also put out a press release on the same day this 8K was filed, announcing the details of this offering. This is typical practice to get the news out to the wider investment community. Form of pre-funded common stock purchase warrant. Form of common stock purchase warrant. Form of securities purchase agreement by and between the company and the investors. Form of registration rights agreement by and between the company and the investors. Press release dated the 29th of July 2026. And finally, the report is signed by Hing-See Wong, the founder and chief executive officer, on the 29th of July 2026. So let's connect the dots. HCW Biologics is raising about $1.6 million. This is coming at a time when their market cap is around $4 million and their stock price has been quite volatile over the past year. The news headlines also mention this $1.6 million private placement aimed at funding their drug programs. This money is crucial for a biotech like HCW Biologics, as research and development are incredibly expensive. However, the fact that a significant portion of the deal involves these pre-funded warrants and that the common warrants themselves require shareholder approval introduces some uncertainty. If shareholders don't approve the common warrants, then investors are essentially getting a share today and a promise for a warrant later, which might not materialize. Historically, companies that rely on frequent dilutive financings, especially those with such conditional components, often face a challenging path ahead. Companies relying on private placements that lead to significant dilution can sometimes face a downward trend in stock price, especially if the promised development goals are not met for investors. This means keeping a close eye on that shareholder vote and the progress of their drug pipeline. The risk I am watching is whether the shareholder approval for the common warrants will actually go through. What I'm actually looking for is sustained progress in their clinical trials that can justify this funding and move the needle on their valuation. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like, comment, and subscribe for more. Join our community Discord linked in the description below.